And the same goes for in-the-money put options. This has a delta of minus 93 at the 65 strike price, and if the Qs were to drop by $1, you would have a gain of 93 cents profit if you were to purchase at this time. And if the Qs went up $1, you would lose 93 cents as well. Now, as you get closer to expiration, as I mentioned, one option is equivalent to the ability to purchase 100 shares of stock if you're purchasing a call, or you have the right to short 100 shares of stock if you were purchasing a put. And the deltas will actually start to decline and decrease the closer you get to expiration. So, for example, right now, since we're on the January 2012s with 42 days left in these options, the delta for the 60 strike calls is approximately 0.24. If we go back to our December options, you'll notice that the 60 strike price has a delta of only 0.04. That's because the closer you get to expiration, it's an either-or situation. In other words, you're either in the money or you're out of the money. If you're out of the money, you eventually getting to expiration date, you will have zero delta. In other words, there's no opportunity for that option to move as you get closer to expiration. You either are in the money or you are out of the money, and at the last minute of trading, all of these, in the last second of trading, all of these out of the money options will go to a zero delta. And all of the in the money options will go to a 1.00 delta. That means that for every penny that the underlying Qs move, the option will move in sync and in conjunction with the move in the underlying stock. So eventually we'll get down to absolutely zero with out of the money options for the delta, and in the money options we'll get to 1. And you can see that already in effect right now with 7 days left. Most of the options that are deep in the money have already gotten to a delta of 1. And a great deal, the number of the out-of-the-money options have already gone to 0 or very low numbers. If we go back to the January options for 2012, which have 42 days to expiration, you can see that there's still some delta left in these out-of-the-money options, and there's still a lower delta on these in-the-money options. And those will continue to gradually increase in delta as long as they remain in the money closer you get to expiration dates. So it helps you determine what your potential profit and loss is. If you're expecting a very big move in the Qs, you would be better off probably buying at the money options that will rise and then gradually increase the delta as they get further into the money, giving you some sort of buffer and an additional profit as it continues to move in your direction. The same is true with the puts. If you were to purchase puts that are in the money or at the money, your situation would normally be greater in your favor if you were expecting a very large move to come within the time frame that you need it to come. In other words, you have 42 days before expiration, and in most cases, unless you're expecting a very large move, an at-the-money put option is a very, very short-term purchase. You only want to purchase these when you know that a large move is coming, or you anticipate a large move is coming on that day or maybe a day or two ahead of time, because otherwise, if you don't, what happens is you begin to lose value. The extrinsic value of an option will lose value as you get closer to expiration. So, for example, if we go back to our position intrinsic and extrinsic value, you can see that the extrinsic value of this 57 strike put is $1.98, which is the value of this option right now because it is out of the money. There is no intrinsic value in this option. The intrinsic value is totally comprised of its entire price of that option. But as you get closer to expiration, we'll go back to our December options that have 7 days left. You can see that the time value has eroded the price of these options to the point where they are half or less than half of what they used to be when they were 42 days to expiration. So you only have an 80 extrinsic value of 0.87. So as time goes on, there's two things that are absolutely true about options. Number one is that they will expire. At some point in the future, they will expire. And it's also true that all out-of-the-money options at expiration expire completely worthless. All right, let's get into some specific examples in the very next video.